There's a dark truth about financial history that nobody wants to acknowledge. Fate isn't random. It's just mathematics wearing a human mask. Every generation looks at the previous one and thinks, we're smarter, we've learned. Technology is better, regulation is stronger. It won't happen to us. And every single generation, without exception, proves itself catastrophically wrong. The 1920s generation believes stocks only go up. They poured money into the market with reckless confidence. Then 1929 arrived, and the Dow Jones collapsed 89% over 3 years. Suicides, breadlines, the Great Depression. The 2000s generation believed housing never crashes. They bought homes they couldn't afford with mortgages that shouldn't exist. Then 2008 hit, and $10 trillion in wealth evaporated in 18 months. Foreclosures, bank failures, global recession. Each time, the experts swore this time is different. Each time, the mathematics proved them wrong. Here's what keeps me awake. Crashes aren't rare accidents. They're not unlucky coincidences. They're mechanical, predictable events built into the financial system's brutal business model. Easy money inflates assets beyond reality. Ordinary people rush in at the top. The insiders exit quietly. Then gravity reasserts itself, and those who arrived late lose everything. We now stand at the edge of a crisis brewing for late 2026 or early 2027. This isn't prophecy or fear-mongering. This is pattern recognition based on forensic analysis of market structure, debt levels, and historical precedent. We are living through right now, in real time, the exact identical setup that preceded the most devastating financial catastrophes in modern history. In this deep investigation, I'm going to show you exactly how crashes unfold, who loses everything, who profits enormously, and most critically, why the 2026 to 2027 event could eclipse both 1929 and 2008 combined in sheer destructive force. This time, 3 factors make everything worse. The scale is larger, the leverage is more extreme, and the people who are supposed to save us have already fired all their ammunition fighting the last war, leaving absolutely nothing in reserve for what's coming. Buckle up. This is going to be uncomfortable. But uncomfortable truths are better than comfortable lies. Let me show you what almost nobody is willing to say out loud. The everything bubble, 3 asset classes simultaneously delusional. Every crash in history begins the same way, with a bubble, irrational exuberance, prices detached from reality, universal belief that it's different this time. Right now, in January 2025, we're not just living through a bubble. We're witnessing the largest everything bubble in recorded human history. This represents systemic risk at a scale never before seen. The simultaneous overvaluation of 3 critical asset classes: equities, real estate, and sovereign debt, all inflated to historically dangerous extremes at the exact same time. Let me walk you through each one, because when you see the numbers, you'll understand why this isn't alarmist. It's just math. The stock market delusion, the most visible manifestation of collective insanity, is the equity market. As of January 2025, the S&P 500 hovers near 6,000 points. Sounds impressive, right? A sign of economic strength and prosperity? Except when you examine the underlying fundamentals, you see something terrifying. The market is operating at valuation levels completely disconnected from any reasonable economic reality. The price-to-earnings ratio for the S&P 500 currently exceeds 28. To put that in perspective, the long-term historical average is approximately 16. We're trading at 75% above normal valuation. This PEE level has only been exceeded twice in the last century. At the absolute peak of the 1929 market mania right before the crash, and during the 2000 dot-com bubble before it imploded. Both times, what followed was catastrophic. But it gets worse. Warren Buffett, arguably the greatest investor of all time, has a preferred valuation metric called the Buffett indicator, total stock market capitalization divided by GDP. Buffett has publicly stated that anything above 120% represents dangerous overvaluation. It's a warning sign that markets have detached from the real economy. During the 2000 tech bubble, this indicator reached 145%. Everyone said valuations didn't matter because the internet changes everything. The Nasdaq then collapsed 78%. Before the 2008 financial crisis, the Buffett indicator stood at 135%. Experts said subprime exposure was contained. The S&P 500 fell 57% in 6 months. Today, right now, the Buffett indicator sits near 185%. Read that again, 185%. That places the market more than 50% above what Buffett himself defined as the danger zone. This is the most overvalued stock market in the entire history of American capitalism. And here's the structural flaw that makes everything worse: concentration risk. The apparent stability of the S&P 500 is an illusion built on an incredibly fragile foundation. Roughly 30% of the entire index, nearly one-third, is represented by just 7 companies: Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla. They're called the Magnificent Seven. But there's nothing magnificent about this concentration. It's architectural fragility. Nvidia alone accounts for approximately 7% of the entire S&P 500 and currently trades at a price-to-earnings ratio above 65. That means investors are paying $65 for every $1 of annual earnings, betting that growth continues forever. If the AI hype cycle fades, and all hype cycles eventually fade, or if any of these 7 companies miss earnings expectations by even 10%, the entire index could fall 50% to 70% in a matter of weeks. We've built a house on 7 pillars, and we're pretending it's a solid foundation. The housing insanity, but the stock market isn't even the worst bubble. That distinction belongs to real estate. People love to say 2008 was the housing bubble, and it was. But here is the uncomfortable truth. The housing market today is more overvalued than it was at the peak of 2008. In 2008, housing prices were roughly 35% above the long-term trend line. Everyone said it was unsustainable. They were right. Prices collapsed 30 to 40% in most markets. Today, in 2025, housing prices are more than 50% above the long-term trend. That makes the current bubble over 40% worse than the 2008 peak in terms of overvaluation. Median home prices in major American cities Los Angeles, San Francisco, New York, Miami, Seattle are at all-time highs, completely disconnected from average household income. The median home price in America is approximately $420,000. The median household income is roughly $75,000. That's a price-to-income ratio of 5.6. Historically, sustainable housing markets maintain a ratio between 3 and 4. We're 40 to 80% above sustainable levels. Young families are locked out entirely. First-time buyers have disappeared. The only people buying are investors, foreign capital, and people stretching budgets beyond reason. This mathematically cannot continue forever. The debt apocalypse, but even housing pales compared to the deepest structural flaw, the unprecedented global debt mountain. By mid-2025, total global debt reached approximately $338 trillion. Let me repeat that number, $338 trillion. That's the largest debt bubble in the history of human civilization. It's roughly 3 times global GDP. The entire productive output of planet Earth for 3 years wouldn't pay it off. The United States sits at the epicenter of this sovereign debt crisis. Federal government debt exceeds $36 trillion, representing a debt-to-GDP ratio of approximately 125%. To put that in perspective, in 2008, right before the financial crisis, U.S. debt-to-GDP was 67%. We've nearly doubled our debt burden in less than 2 decades. Here's where it becomes mathematically impossible to sustain. Interest payments. The U.S. government now pays between $1.2 trillion and $2 trillion annually just in interest on existing debt. Not paying down principal, not funding programs, just interest. That's now the single largest line item in the federal budget, larger than defense, larger than Medicare, larger than anything except possibly Social Security. Think about what that means. We're borrowing money to pay interest on money we already borrowed. That's the textbook definition of a debt spiral. This mirrors the terminal stages of every failing empire in history. Rome collapsed under unpayable deficits. The Soviet Union imploded when debt service consumed everything. Mexico shocked the world in 1982 when it simply admitted it couldn't pay and defaulted. Debt makes a nation look rich and powerful until the bill comes due. Then it reveals the truth. It was an illusion the entire time. The perfect storm. Well, why 2026 combines every previous crisis history doesn't repeat exactly, but it rhymes with terrifying consistency. And the setup for 2026 rhymes with both 1929 and 2008 simultaneously. In 1929, leverage exploded. Americans could buy stocks on margin with as little as 10% down payment. Put $1,000 down, control $10,000 worth of stock. Margin debt reached 10% of total GDP. The universal belief was that stock market crashes were impossible. The Federal Reserve had supposedly mastered the business cycle. Everyone was getting rich. Why worry? Then October 1929 arrived. Margin calls forced mass liquidations. The Dow collapsed 89% over the next 3 years. Banks failed by the thousands. The Great Depression destroyed a generation. In 2008, the leverage took a different form. Subprime mortgage. People bought homes with zero down payments. Banks packaged toxic loans into rated securities. Mortgage debt reached 100% of GDP. The universal belief was that housing prices never fall nationally. Real estate was always a good investment. The math was ignored because everyone was making money. Then the subprime defaults began. The entire system seized. The S&P 500 fell 57% in just 6 months. $10 trillion in wealth evaporated. Lehman Brothers collapsed. Only massive government intervention prevented total systemic failure. Now look at 2026. We have both forms of leverage simultaneously. Stock market leverage through options, derivatives, and leveraged ETFs. Real estate leverage through mortgages at the highest prices in history. Corporate leverage through cheap debt that must be refinanced at much higher rates. Plus something neither 1929 nor 2008 faced. Massive sovereign debt with no fiscal capacity to respond. We have an everything bubble, record leverage across every asset class. And the dangerous delusion that central banks and governments will always save the day. Except this time, they can't. Policy exhaustion. The Fed has nitrogen monoxide ammunition left. What makes the coming crash potentially worse than anything in modern history is policy exhaustion. In 2008, when the crisis hit, the Federal Reserve still had tools. They cut interest rates from 5.25% all the way to zero. They launched quantitative easing, expanding the Fed's balance sheet from $900 billion to over $4 trillion. They printed money and bought assets. Simultaneously, the federal government launched TARP and massive stimulus programs. This was possible because government debt in 2008 was only 67% of GDP. There was still borrowing capacity. These interventions worked. They stopped the crisis from becoming a full depression. Markets eventually recovered. But today, the Fed is completely trapped. They cannot cut rates to zero because inflation remains elevated above target. If they slash rates, inflation roars back immediately. They cannot print unlimited money through quantitative easing because they already tried that between 2020 and 2022. The result? The worst inflation in over 40 years? Prices rose 20 to 30% on essentials like food, energy, and housing. The public will not tolerate another round of massive money printing. The political backlash would be severe. The Fed is now locked into a strategy called financial repression, keeping interest rates below the inflation rate to slowly erode the real value of debt. This silently punishes savers while forcing them into increasingly risky assets to chase returns. Meanwhile, the federal government cannot launch massive stimulus because debt is already 125% of GDP. Borrowing. Another $3 to $5 trillion would push debt to unsustainable levels, potentially triggering a sovereign debt crisis. The crisis has migrated from the private sector to the sovereign state itself. In 2008, governments could save the banks. In 2026, who saves the governments? The trigger. What lights the fuse? The crash doesn't need a dramatic trigger. The system is already loaded. All it needs is someone to pull the pin. 3 likely triggers stand out as most probable. Trigger 1, commercial real estate collapse. Over $2 trillion in commercial real estate loans mature between 2025 and 2026. These properties, office buildings, shopping centers, hotels were financed at near zero interest rates. Now they must refinance at rates 3 times higher, while property values have fallen 30 to 40% due to work from home trends and declining retail foot traffic. Many properties generate less rental income than their new debt service payments. Default is inevitable. Regional banks hold massive exposure to CRE. When defaults accelerate, it threatens the entire regional banking system. Trigger 2, corporate debt crisis. Corporations borrowed trillions at near zero rates between 2010 and 2021. Now that debt must be refinanced at 7 to 8% interest rates. Companies that were barely profitable at 2% rates become insolvent at 8%. Bankruptcies are already rising. The high-yield bond market, junk bonds, faces potential collapse. When corporate bonds crash, it spreads to stock prices. When stocks crash, consumer confidence collapses. The feedback loops accelerate. Trigger 3, geopolitical black swan war. Energy shocks, political instability, pandemic, or any major unexpected event could trigger mass liquidation. Investors are fully invested with no cash reserves. Any shock forces selling. Selling triggers margin calls. Margin calls force more selling. The cascade begins. The 5 phases. How the crash unfolds. Once triggered, financial crashes follow a predictable pattern. It happened in 1929. It happened in 2008. It will happen again. Phase 1. Initial shock, markets fall 10 to 15% rapidly. Investors are surprised but relatively calm. Just a correction, they tell themselves. Buy the dip mentality dominates. Phase 2. False recovery. Markets stabilize or even bounce slightly. The Fed makes reassuring statements or implements modest interventions. Investors convince themselves the worst is over. This is the trap. Phase 3. Cascade, forced liquidations accelerate. Margin calls, redemptions, credit markets freeze, fear becomes panic. Markets fall 50 to 70% from peak. This is where the real damage occurs. Phase 4. Panic bottom. Maximum fear, bank failures possible. Emergency government intervention. Markets hit bottom, blood in the streets. Phase 5. Slow recovery. Markets stabilize, but full recovery takes a decade or longer. The damage to retirement accounts, home values, and consumer confidence persists for years. Who loses, who wins? The great transfer crashes don't destroy wealth. They transfer it from those unprepared to those positioned correctly. Today, over 58% of American households hold stocks through retirement accounts. The middle class is fully invested and fully leveraged. They will be the first casualties. Inflation, which remains above target, acts as a silent wealth tax, transferring purchasing power from citizens to the government. But every crash creates winners. Joseph Kennedy in 1929 famously shorted the market and became even wealthier. John Paulson in 2008 made $15 billion betting against subprime mortgages. Warren Buffett deployed capital at the bottom and made billions. The winners of 2026 will be those who sold early and preserved liquidity, held cash to deploy at the bottom, avoided leverage, entirely bought assets during maximum fear survival strategies. Positioning for the inevitable. You cannot prevent the crash, but you can position yourself to survive and potentially profit. 1. Reduce equity exposure. If stocks are 50% overvalued, reduce holdings accordingly. Raise cash. TWO. Hold liquidity. Cash is optionality. Cash lets you buy when prices collapse. 3. Own hard assets. Gold, silver, productive land. Assets with intrinsic value independent of the financial system. 4. Eliminate personal debt. Debt destroys you in a deflationary crash. Zero debt is the safest position. 5. Protect income. Your earning power is your most valuable asset. Skills, relationships, flexibility. 6. Prepare psychologically. The hardest part isn't selling high, it's buying when fear is maximum. Practice mental resilience now. The warning signs. What to watch. The indicators are already flashing red. Commercial real estate defaults rising. regional bank stress increasing, high-yield bond spreads widening, yield curve signals, corporate bankruptcy filings accelerating. Each week brings new confirmations that the structure is cracking. Closing, the iron law of mathematics, there's an iron law in finance that cannot be broken. Infinite debt and infinite delusion cannot persist forever. Eventually, always, inevitably, mathematics reasserts itself. The bubble is fully inflated. The leverage is at extremes. The belief in permanence is universal. The authorities are out of ammunition. We're simply waiting for the trigger. And when it comes, whether in 6 months or 18 months, the pattern will repeat exactly as it has every time before. The only question is whether you recognize the pattern now and prepare accordingly, or whether you learn it the hard way. History is screaming the warning. The mathematics are clear. The setup is complete. The 2026 reckoning is coming. The only question that matters, will you be ready? Subscribe for updates as this unfolds. Comment below, are you positioned for the crash or still hoping it won't happen?